Hi stock market nerds, my name is Jonathan and I'm your dividend investor. And as soon as I get in a conversation with my friends about the dividend strategy, there's one question coming up, and it is like, it's a very lazy question obviously, but I think it's also a very good question. And the question is, Jonathan, what is your favorite dividend stock and why is this your favorite dividend stock? And obviously right now I won't tell you my favorite dividend stocks because I want you to think about which companies do have a good business model and do have a good dividend policy, so that you can find your own dividend stocks. And that is also the goal for today's video, to create a dividend criteria list together with you, and with that list we can choose the right dividend stocks. So what is important if we decide to choose a dividend stocks? What do we as investors wish about the company? First, we want, in the long term, we want an outperformance and we want a lot of dividends, because that's the reason why we're investing, obviously. And to achieve that goal, we need to screen the company, and there are thousands of numbers and ratios, and there are so much things that you can analyze. But today I wanna keep focused and give you the three most important criteria. And the first one is the dividend yield. In my mind, it should be higher than 2% annually, because if it is lower, then it just takes a very long time until you get those nice returns of 5, 6, 7, 8, 9, 10% on your invested capital. Because it needs, even if the yield keeps growing from year to year, it just takes a lot of years. It takes several years until you achieve 5, 6, 7, 8% dividend yield. So you shouldn't start with a too low dividend yield, and it is better, the higher the dividend yield, the better it is. But that's also my next and second point, the dividend payout ratio. So the dividend payout ratio shows us the percentage of the earnings of the cash flow that gets paid out to us as investors. And if this ratio is too high, I mean, what is too high? It depends on the business model, but usually a payout ratio that is over 70% isn't healthy in the long run, because then more than 7 of 10 cents of the earnings get paid out, so there's very less capital left to get reinvested in the business and to grow the business. And that is what we want to achieve, as well as high dividend yields. It is dividend growth, because if we start with a stock that pays out 3% a year and it keeps growing it with 7% a year, after 10 years we achieve a dividend yield of 6% based on our invested capital. So, and if this repeats, then after 20 years we already achieve 12%. So if we decide to invest, let's say $50,000, then we achieve dividends of $6,000 a year. But it could be actually a bit higher if we choose to reinvest all the dividends year for year. Then it is even higher in the long run. But that's the second point. You should look at the stocks, and the company shouldn't pay out more than 70%. I mean, it depends on the business model. There are also capital intense business models. Those companies shouldn't pay out 50%, but in general I think 70% is a good number. If it's between 20 and 50 or 60, it's like perfect. It's what we wish. And the third and last point is, I don't wanna own dividend stocks that cut their dividends too often, or that don't raise their dividends year for year. I don't want those stocks, because I think if they have to cut the dividends, then they prove us as investors that they don't have a good business model. Yeah, if there's a small crisis and economy isn't as good as it used to be, and they already have to start cutting the dividends, that's a very bad sign, because it's proof that the business model and the earnings depends on the economy or whatever. And I prefer owning companies that are able to grow their dividends and earnings year for year. I mean, if they cut their dividends once every decade, or maximum once a decade, then I could be living with that. If it isn't a big cut, if it's just like 10% or 20%, then it might be okay, because financial crisis, it was a very strange time, and some managers decided to pay out a bit less because they didn't want to borrow a lot of money at that times, but they shouldn't do this too often, because that's just a bad sign. I mean, if a company is able to grow their dividends for, let's say, 20 or 25 years, which are the dividend aristocrats, by the way, then these managers and this business model is a proven business model, because it doesn't matter if the economy is up or if it's down, they keep paying out more and more every year. And that's what a dividend investor want to achieve. So these companies get my trust, and I'm investing in those companies. So those are my 3 criteria. And now I'm very interested if you agree with me, or if you do have another strategy, then just comment below and we'll have a very nice discussion, I guess. And don't forget, usually the worst stocks are the stocks that doesn't pay a dividend. You won't have any earnings out of these stocks, usually, obviously. There are a few other stocks like Berkshire Hathaway, which is a very good stock. And so I think that's it for today. See you next time. Goodbye, and don't forget to subscribe to this channel if you like this video. Take care. Goodbye.